learning to get the most out of Bollinger Bands. Now tonight we're going to learn how to build the bands, how to place them on our chart, how to read them, and then lastly, how to incorporate them into a trading strategy. Now tonight's class, I'm going to use the term security, but I might say the euro. In fact, I know I'm going to say the euro because we're going to be working on a euro chart. Or I might say oil or gold, or I might say Facebook or Bitcoin, but I'm not talking about any specific asset. I'm talking about all tradable financial instruments. I'm also going to intermix the terms trading and investing. Now we're here because we're traders, and we know the difference, but it gets very boring saying trading, 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 trading. So I'll say investing, and I'll say trading, and I'll say investing. You know what I'm talking about. Now, the funny thing is, I've been trading since 1972, or investing since it's actually trading. I used to trade agriculturals, and I would sit in the pits back before we had computers, and we would sit there and we would read ticker tapes to get price, and we would get the crop reports now and then by fax, and most of the time several days later. We didn't have the internet. We didn't have faxes. We didn't have mobile phones. So what did we rely on? We relied on the data. But it was a much slower paced world. But everybody today seems to ask me, what should I buy? What should I sell? What will the prices be tomorrow? What will the prices be later today? And you know something? I don't have a crystal ball, and I don't have a Ouija board. And anybody out there who tells you they can tell you what the price will be tomorrow, later, today, next week is full of BS. Price action is random, and nobody can predict exactly what's going to happen in the market. So if you're thinking that Bollinger Bands, the technical analysis, is going to tell you what to do and what price is going to be and where to go, good luck to you. And when all these gurus are out there trying to sell you systems and AIs and robots that are going to tell you exactly what to trade and how to trade it, good luck to you. But if you're attending this webinar with the hopes that technical analysis using Bollinger Bands will improve your investing and trading, that it surely will. Now remember, trading is mostly about risk management, constantly reducing your risk, taking only high probable trades where the risk is nominal. Now, Bollinger Bands were created by John Bollinger, hence the name Bollinger Bands. And the nice thing about him, John is still active in the marketplace, and he operates his Bollinger Bands website. So it's one of the few indicators that not only do you have to read, you have tons of discretionary material, you can actually go to the horse's mouth and read exactly what he says, how he developed, why it works, when it should work. You can get this directly from the creator. Now, there's a bunch of published information about how to trade with Bollinger Bands. Most of that is some guru who's used the bands, adapted the bands, made the bands, and are trying to preach you some strategy. I don't want to preach you a strategy. I want to teach you today how the bands work, how we put them on our charts, and how we read them. And then I'll give you a couple strategies that so you can see how they're used. But then once you know about them and understand them, you can then determine how to apply them in your trading strategy. Now, I know some of you don't know what Bollinger Bands are, so let's go over to a live chart. Let's see about putting this on a chart. And then we'll come back and talk about the different layers of this. So I'm on your screen, you are looking at my standard teaching chart. It is the Euro US dollar chart, 30-minute chart. It's a live chart. It's up to date. It has nothing to do with tonight's class though. I just want you to know that it wasn't picked to show you a possible trade in the euro. Now, all of these red lines, blue lines, purple lines going horizontally across my chart have nothing to do with Bollinger Bands. They are all about my support and resistance lines that I've drawn on the past. And basically, as price moves, the ones that are current come on the chart. But this got nothing to do with tonight's class, but I can't take them off of my charts because they're historic lines that go forward. Now, across the candlestick, actually, let's change it for a second over to I was changing the bar chart. Where did the bars go? Candlestick. Oh, there we go. It's the top. Okay. So now we have, and not for any reason other than make it's easier for you to see. We have a bar chart. The gold line going across the bar chart, okay, is a 20-period moving average line. That's it, a plain and simple moving average line. But Bollinger Bands is one of the indicators that's actually dropped directly onto your price charts. And after we go through this tonight, you'll never have to do any of this because you just click on Bollinger Bands and it's automatically done for you. But when things are done for you automatically, you tend not to understand all the how you got to that automatic part, and you have to understand that. So we start out with this 20-period moving average. This is the center line or the basis line for Bollinger Bands. From there, Bollinger Bands puts onto the chart a line above and a line below based on a statistical calculation called a standard deviation. Now that is a mouthful. But Bollinger Bands are then put on your chart and they're laid over top, and they're called bands because they're bands that go around the price. Sometimes they're referred to as envelopes, but an envelope doesn't have a center line. Bollinger Band has a center line. So let's turn off this moving average line, and we're going to turn on my Bollinger Bands line. And I've already gone up to indicators and clicked on Bollinger Bands and put it here in the chart. So it starts with the basis line. That's that 20-period moving average. Then it uses that moving average to calculate what's called the upper band and the lower band. And it's based on a 2 standard deviation. Now, standard deviation is a statistical calculation. It was not developed for the financial markets. It's part of a mathematical formula used by statisticians for many, many, many things. And you're going to have to understand what a standard deviation is. You'll never have to calculate it. You'll never have to know what it is. After tonight, you'll never have to think about it, but you have to know what these bands are and what these calculations, where these calculations come from, so that you can spot inconsistencies or errors or false signals. If you were just to look at this and follow a set of rules I were to give you, then you're just following blindly without any knowledge. But now you see this is what a Bollinger Band on your chart will look like. The shape of the Bollinger Band tells you nothing. Sometimes they look like dragons. Sometimes they look like snakes. Sometimes they look like space aliens. They would look like all kinds of weird things. Now, from the Bollinger Band, there are a couple things we can notice. The bands get very, very wide. When the bands get very wide, it's telling us the market is very volatile. When the bands are contracting or contrite, it tells us the price is moving in a consolidation or sideways movement. But the width of the band, even though you may not have price movement, because it's not based, the volatility isn't based on the overall price of the asset. It tells you that the market is very volatile. And this helps you determine where you have to put your stop loss. Because the more volatile the market is, the larger you need your risk reward ratio, because you have to have your stop loss farther from the price so you don't get stopped out in the markets. But before we get too far, let's go back and talk about this standard deviation. And I promise you, it's a very complex calculation. Once we discuss it, you'll never, ever have to worry about it again. But you have to know what it is. So Bollinger Bands can be applied in all financial markets, including equities, Forex, commodities, and futures, and cryptocurrency. And Bollinger Bands can be used in most time frames, from very short-term periods to hourly to daily to weekly. So it's one of the few indicators that you can use on very, very short-term charts, because a lot of indicators tend to give you false signals in the smaller time frames. Now, Bollinger Band answers a very important question. If you go read about or go to Bollinger's site, basically the only thing he's telling you is Bollinger Bands tells you whether price, the current price right now, is high or low on a relative basis. Okay. So if something's telling you the price is high, you surely won't want to buy at the highest price. When something's low, you would want to possibly buy. When something is too low, you don't want to sell. So by definition, price is high at the upper band and price is low at the lower band. That bit of information is incredibly valuable. It is even more powerful if combined with other tools such as indicators for confirmation. Now, as I said, Bollinger Bands are a technical analysis tool that fall in the field or type of band or envelope. The biggest difference between a band and an envelope is an envelope doesn't have a center bar to measure. It just envelops price. So it would have an upper and a lower band. Bollinger Bands is a band because it uses that center band. Okay. Now, increasingly interesting though, in the real world, no statistician would ever calculate standard deviation by hand. Like I said, it is a very complex mathematical formula for the statisticians use. But we're going to have to go through it. So I'm going to try to explain it to you in terms of the market or in terms of finance. So standard deviation is the measure of the dispersion of a data set from its mean. So if we were to say that in the easier way, standard deviation is the measure of the difference between the open, the high, the low, and the close from its moving average. It is calculated as the square root of the variance by determining the variation between each data point. So it's going to determine the variation between the open, the high, the low, and the close, and its moving average, that center line. If the data points are farther from the moving average, there is a higher deviation within the set. So in its simplest form, the mean is simply the average of all the data points in the given set, or the moving average. In investing, for example, you might want to know the mean closing price of the last 20 days. This can be obtained by adding the closing price for each session and dividing by 20, just what we do for a simple moving average. Because markets are fickle at best, traders and analysts use moving averages to adjust daily or based on the time frame to incorporate the most updated data, because a moving average is always using the close of the most current point. You're looking at a 5-minute chart, it's the close of that 5 minutes. This means the calculation is always taking into account the most recent session's movements, and the older sessions drop off the calculation. Now, we've developed what's called an exponential moving average to calculate or weight the data point of the most current data point, giving it more significance. Now, standard deviation is calculated based on the mean or moving average. Same word. The distance of each data point of this moving average is squared, summed, and averaged to find the variance. The difference. Or to put it another way, variance is derived by taking the mean, the moving average, of the data points, subtracting the moving average from each data point individually, squaring each of these results, and then taking another average of the squares. Or standard deviation is simply the square root of the variance. Okay, we're done. Now we know it's a very complex mathematical formula that uses the average minus the difference between the open, the high, the low, and the close in the time frame. So we start out with our base band, which is our 20-period moving average. And from there, we calculate an upper and a lower band based on 2 standard deviations. Now, before we go farther, there's a lot of gurus out there, a lot of analysts out there, a lot of people who want to be develop their own systems that will tell you use a 2.5 standard deviation. Use a 1.5 standard deviation. You can do all that. You can change it to a 10-period moving average based on a standard deviation of 1.5. But guess what? It's no longer Bollinger Bands. It's Barry Bands or Billy Bands or Bobby Boo's Bands. And in order to do that, somebody has to do all the testing and all the back testing and find all the little idiosyncrasies that work with that, or did it only work in this market? So when some guru is telling you use a 1.5 standard deviation with a 10, okay, you've got to know everything he's trying to teach you, and then you got to find out how well he's tested his adjustments, what markets he's tested, and then you have to get all that information sucked out of his head so that you do the right thing. Now, you can decide you think it will work better with a 1.5 standard deviation or a 2.5 standard deviation, but then you have to do your testing to understand what it's changing and how you can then make sure that you're not just making a whole bunch of mess for yourself. I have a lot of friends who use a standard, the 2.5 standard deviation, but they all know why they did that. So now that we have, let's go back to our chart. So now that we have our standard Bollinger Bands dropped on our chart, and I'm going to take this and make it back to candlesticks. Okay. We need to understand what all of this mess is telling us. Now, the first thing we talked about is price is relatively high when it is near the upper band. Price is relatively low when it's near the lower band. But one of the reasons we use this center moving average band is Bollinger Band, as you can see, this is called riding the bands. This is a beautiful scenario for an uptrend. But price doesn't go up, up, up. As you know, price moves in peaks and valleys. So when price peaks down here, you don't want to freak out. That's not telling you that anything has happened. Because price then continued upward and continued riding that band. Okay. Here it came down. Now at this point, we have no idea what's going to happen. But the critical telling point is when price breaks the moving average. So there's certain things we need to look for in Bollinger Bands. We want to see when price is moving upward that is staying near the outer band. When price moves up to that outer band and is rejected by that outer band, it's telling us that that trend is in trouble. Not that it's ending, it's in trouble. We don't know that that trend, because like you see here, you can see it bounced off and continued back up. But here, it still was not able to ever come near this outer band again. But we still don't know what's in trouble that is going to reverse until it breaks the moving average. Once again here, rode the bands, was rejected, came back up. We're not in trouble until it broke the moving average, and then we know it's moved, that downtrend has ended. We know that for sure. Okay. And then it moves into an uptrend. Again here. Okay. Here. You can see this happens over and over and over and over again. Problem is you're saying, okay, guy, you're telling all this, but that's really easy to see in the past. No, we could have seen, anytime you look at the chart historically behind, you can see what happened. You can say, oh, look at that. It did something beautiful for us. But you can't trade it because the only place we can trade is here. So with Bollinger Bands, they are very consistent. They give you a lot of information, but you have to learn to trust them. So for instance, right here, we got the cross of that lower band. We don't know how far that downtrend is going to go, but you have to trust that this trend is over and we're going to move into a downtrend because you need to be able to trade it here. But if you've watched the bands long enough, not this particular, but you've traded them long enough, you will learn to trust in that signal. But you'll also learn to understand what is the difference between rejection and not rejection by the upper band. Okay? And like I said, one of the keys is breaking the moving average, and it's also with how much conviction it broke that moving average. See, here, we broke the moving average. Here we broke, that wasn't, but then we got the conviction here. Okay? So now we would have been ready. So these are the things we have to learn to watch with the bands. Now, Bollinger Bands serves many purposes. It gives us pattern recognition. It gives us reversal signals, and it gives us trend analysis. So we were just talking about reversal signals just a second ago, and we were talking about analyzing the trend. The trend was getting in trouble, but doesn't mean it's ending, or it's telling us we're getting the reversal signal. The reversal signal comes with the break of the moving average. The trend continuation or conclusion, or the trend being in trouble, comes from the rejection of that what? The rejection of the outer band, whether it's the upper band or the lower band, because everything is reversed. It's mirror images. So the first part of Bollinger Band is reading the pattern recognition. For most of us here and most of our trading styles and the fast-paced markets in which we trade, this doesn't help us. It works, but it takes a long time for the W or the M formation to form. It takes you a long time to notice it. If you were buying stocks, maybe you'd have the time. But in a fast-paced currency market, you may not. And I don't like indicators. Like I don't ever trade head and shoulders or inverted head and shoulders. First of all, I don't see them developing. My eyes just don't see them. And when somebody points it out, I can see it. And it doesn't kind of fit my trading style. But this might fit your trading style. So what we're looking for is this pattern. When it happens, it's very reliable. We either have the W or the M. And it all depends on whether it's coming off of an uptrend or a downtrend. So in this case, it's coming off of a downtrend. So we have the formation of the W. The W is formed by price falling down, riding the outer bands, getting rejected, okay, which doesn't tell us anything. Comes back up, breaks the upper moving average, but hits a high much lower than the previous trend. But here's where we're getting the telltale. Comes down and forms a second bottom that was equal to that first bottom. And we call this the N formation. There's either a right side up N or an upside down N. Let's see, how do I draw an upside down one? This way, and that way. When we get a W formation, we have the upside down. It's at this point we might recognize it. We have the first leg, the second leg, the third leg. When it gets rejected off the bottom, and that bottom is equal to that first bottom, okay, we might see the W forming. At the point it breaks the moving average, it's giving you a very, very, very smack in the back of the head buy signal. And you can calculate your reward, your target, by making it equal to the height of the beginning of the formation. But like I said, it's a lot of effort, a lot of time. Whether you're looking at a 1 hour chart, this incorporated, oh, 40 hours. Okay, if you got into 15 minutes, it's still 40 candles. It's just not something I trade. I'm not telling you it's bad or good. It's just not something that fits my style of trading. We also have the exact opposite in the M formation. It's just a reverse image coming off of an uptrend. First top down forms the center, second top down. It's just, and it's basically like a head and shoulders. Head and shoulders forms up, pushes the shoulder, comes down, forms the neckline, but then it forms the head and then forms the neckline. But you don't get that in Bollinger Bands. You get this in Bollinger Bands, you get the M or the W, because if you notice, it's bouncing off and on of the outer and upper bands, and it's breaking the moving average. Now, this works, and Bollinger Bands works extremely well when combined with other indicators, and Bollinger Bands with RSI is a perfect match. And I'm going to show you a little presentation I got for you on using Bollinger Bands with RSI and MACD and how well they all work together synonymously to give you a very good trading strategy. Now, the thing about Bollinger Bands is we are looking for something very important. And you notice before I mentioned to you rejection of the outer band, whether it's the upper band or the lower band. So after a trend move, price fails to reach the outer band as the uptrend becomes weaker. So what that's telling you is if price is trending up and it gets rejected and can't reach that upper band, that trend is in trouble. It's not telling you it's going to reverse at that point, but it's in trouble. Because sometimes trends change their speed. You know, a trend can be very, very hard and moving up fast, and then it could turn and move on a slighter angle, but still continue upward. And then we also have during consolidation, price spikes to the outer band, which gets rejected immediately. That's telling you. So you have the ones that are coming off of trends, and you have the ones that are coming out of consolidation. But rejection is what you're looking for. Now remember, during trends, the moving average holds very accurately, and a break of that moving average is usually a meaningful signal that the sentiment has shifted. Okay. Now, moving average can be used as a trade exit signal where a trader does not close the existing position unless price has broken the moving average. So like I showed you, when price gets rejected by the upper or the lower band, it can stay in that direction. The cross of the moving average is telling you that trend has now not necessarily ended, but it's in disaster. And if you're in the market, you would like, and you're in the market in it, you'd like to close your position. By combining the Bollinger Band with the moving average, a trader can already create a robust trading method. But again, you have to practice these over and over and over again so that you trust what your eyes are telling you, so that you're able to trade in the wall going forward. Because if you wait for everything to unfold, it's too late. So you only to get this by doing, like football players, they do scrimmage after scrimmage after scrimmage to practice play after play after play, so that when Sunday's game comes, it's natural action to do that. Quarterback's back there. He sees all of his players out in the field, and he knows exactly where he wants to snap that ball. And that pass receiver is running basically with his back to the quarterback, and he knows the point he needs to be to turn around and grab that ball. Well, this is what's happening: is the running backs are running, the pass receivers are running, the quarterback is fielding, and he's about to snap that ball, and you have to trust what you're doing, that ball going forward is going to be where you need it to be. And you only get that by practice. So we can see here, price came down, rode the band, came back up, broke the moving average, and it moved back up. Now, the thing about Bollinger Bands is you have to keep in mind, Bollinger Bands does not tell you price. It doesn't tell you how far a move will be. Now here, look at that. We have beautiful riding the bands. Price eases down, but it stays above the band, above the moving average, because this is that push and ease in price. and then price mounts back up, and it doesn't matter whether they're red or green candles. But now what happens here? Price is beautifully riding that upper band, and in here it tries to push to that upper band. Price is still moving in an uptrend, but gets rejected by that upper band, can't get near it. Tells that price is again in trouble. Now here it stayed above the moving average. Here, once we broke that moving average, we know that that current trend is ended. We then come down, we start moving the bands again. Okay, bounce off it, don't break the moving average, bounce off again, don't really break the moving, and continue down. We could have ridden this short trade all the way down to here. Now, while Bollinger Bands are exceptionally helpful in determining when an asset has overshot the upside or the downside, it's important to use the bands to also set risk conditions, not just entry points. Additionally, risk and reward should be set based on the width of the bands or volatility. The narrower the risk reward, we can have narrower risk reward ratios during lower volatility or when the bands are tight, and we need to have bigger risk reward ratios during high volatility. Now, in contrast to most other indicators, Bollinger Bands are non-static indicators. They change their shape based on the recent price action, accurately measure momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of the trends and get a lot of important information this way. Now, before we go on, let me mention to you, if you look on your screen, you're going to see 3 handouts I put together for you. There's nothing you have to register for, nothing you have to put any information for, nothing you have to pay for. They are PDF files. If you just click the download button, you can download them and move them around at your convenience at a later time. But you can only get these in a live class. So what I've given you is number 1, a handout that covers everything we talked about in today's class. Then I've given you a technical analysis guide from investing.com. This is a huge resource guide. It covers everything in technical analysis, from charts and charting to support and resistance and trend lines to all the different types of indicators. It is an excellent resource guide. Download it, use it at your convenience for whatever you want to research in the future. And then I've given you the top technical indicators. This takes the 5 most popular technical indicators and explains them to you, and also shows you how to use them in using Confluence together. Okay. So please, they're only available in this class. They're not available in the recorded version. So if you don't download them now, and if you have a mobile device, just download them on your mobile device also. They're small files. Okay. And then you can move them or send them to yourself wherever you want later. Now, there are a few things you need to pay attention to when using Bollinger Bands to analyze trend. During strong trends, price stays close to the outer band. If price pulls away from the outer band as trend continues, it's showing fading momentum. Repeated pushes into the outer band that don't actually reach the band show a lack of power. And again, it's just a reverse off of a downtrend. And the break of the moving average is often the signal that the trend is ending. So again, the only way you're going to be able to trade at the wall moving forward is to practice. So when you see these patterns develop, or you see what's happening at the wall, you can take a position and feel comfortable with it. Now, let me share with you a little presentation on how you could combine Bollinger Bands with a couple indicators to build a trading strategy, and how you would use the Bollinger Bands to interpret what price is trying to tell you. And please, it's very, very important to understand multicollinarity and confluence. It means Don't use indicators that tell you the same thing, that do the same thing, and use different types of indicators to work together to give you a understanding of what to do.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse, and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the super trend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the super trend indicator to change red here before taking the short trade. So now we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.
So that was one way to combine Bollinger Bands with other indicators. Now, there's a way that you can use Bollinger Bands on their own, and that's called the Bollinger Band squeeze. And this is a very straightforward and relatively simple strategy. Sometimes it's amazing that it works, but it works extremely well, and it's been around for a long time. And it's simply noting that when we can find that the bands are contracting and we get this long period of contraction in the bands, we know the price is being squeezed in there, and at some point it's going to break out. When we get that breakout, and that breakout is combined with a jump in volume, we can then trade in the direction of that break. So even though the Bollinger Band squeeze, and I'm going to show you this step by step in a second, even though the Bollinger Band squeeze is a straightforward, chartists should at least combine this strategy with basic chart analysis to confirm signals. For example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below support can be used to confirm a break below the band. Unconfirmed band breaks are subject to failure, and this is why I said note volume. So I put this together in a set of screenshots for you, or PowerPoint screenshots, and I'm going to share with you. It's only a few minutes long. There is no narration. The word, it's written out on the screen, so please carefully read what's going across your screen. It's very simple. It's very short, but it will explain this to you in easy to follow, simple little method. You'll see it actually happening on your charts. So as you can see, Bollinger Bands are a multifaceted trading indicator that can provide you with a lot of information about trend, buy and sell balances, and other potential trend shifts. Together, the moving average in RSI and Bollinger Bands makes for a great foundation for any trading strategy. So try them out, test the bands, practice them until you feel comfortable with them, and then add them into your trading. But like I said, you have to practice and learn to trust what the bands are telling you. So please make sure you download those handouts I gave you. Have a great trading week. I know what we're all going through. Most of you, I don't know where everybody's from tonight, but most of you, I think, are from countries that are locked down like I am. And use this time to study and learn and explore. It's a great time to get a demo account and just practice demo trading. Make your strategies work, test your strategies out, and go to Alvexo, www.alvexo.com, open that demo account and just practice. Use this time that we're going through all of this stuff around the world and turn it into something valuable for yourself. Thank you very much. And again, thank you for supporting Alvexo and investing.com. And have a wonderful night now. Bye.